Okay, so today we're doing May-June 2021 question paper 12. So I can only find the question paper 12 and 13 for this particular sitting. So we'll start at the bottom. Just remember question 29 here is no longer relevant on the new syllabus. Expenditure reducing, expenditure switching, no longer relevant on new syllabus. So question 30. Which policy will not cause a reduction in the rate of inflation? So what we're looking for, something that will cause a reduction in the rate of inflation is something that will cause aggregate demand to move to the left. Okay, so increasing income tax is a contractionary fiscal policy designed to move AD to the left. That will help us to reduce the rate of inflation. Reducing government spending is also a contractionary fiscal policy designed to move AD to the left, will also help with reducing inflation. Reducing interest rates, however, is an expansionary monetary policy designed to move aggregate demand to the right, and therefore may increase the rate of inflation, not decrease the rate of inflation. And finally, removing subsidies, well, that depends. Are they industry-wide? Are they something that will affect aggregate demand and aggregate supply, or are they something that will only affect the microeconomic side of the economy? And if so, then it's unlikely to have an effect. Okay, question 28. Why are higher interest rates together with increased taxation on expenditure likely to cause domestic deflation? Okay, so higher interest rates is contractionary monetary policy, and increased taxation is contractionary fiscal policy. Both designed to move AD to the left. So we can get rid of A, we can get rid of C, because the two of them mention expansionary policies, which they are not. So, because the monetary and fiscal policies involved will cancel each other out, that is not true. Just because we increase the interest rates, that doesn't mean that the drop in consumption and investment from increasing interest rates will necessarily tally up with the drop in consumption and investment from increasing the rates of taxation. What it does mean, however, is that they will reinforce each other. And what they're trying to say by that is that AD will move left from the higher interest rates, and then AD will move further left from the higher direct taxation, which may cause deflation. Remember, we have two types of deflation. We've got good and we've got bad. Bad deflation is from aggregate demand moving to the left and then dropping the price level, and real GDP will also drop. So they'll reinforce each other by continuing the same movement in aggregate demand in the same direction. Okay, increased international competition leads to a worsening in the country's current account balance. In the absence of any offsetting factors, how is this likely to affect the exchange rate and domestic cost push inflation? Okay, so first of all, if there's a worsening in the country's current account balance, then what we'd expect, or what will happen, is that imports are rising. If imports are rising, then there will be a decreased demand for the currency. Ours, that is, which will result in a depreciation of that currency. So our currency will depreciate. Now, in terms of cost push inflation, if our currency depreciates, then the price of the imports will rise. And if the price of the imports rise and we still have to import raw materials, what that will do is that will actually make our cost of production rise. Because we'll still have to import the materials, and we'll now be doing so, which will make it more expensive on the domestic market for our consumers. That cost of production rising will move aggregate supply to the left and will cause or will increase cost push inflation. So correct answer there would be D. Between 2011 and 2013, retailers reported that expenditure on domestically produced products and imported goods had reduced. This was because consumers did not take out loans as the economy was in a recession. What is the likely result of this? Okay, so very simply, imports have gone down, right? So if our imports have gone down, does that mean we have a decline in unemployment? Not necessarily, right? Possibly, but not necessarily. Economy was in a recession, consumers did not take out loans. Doesn't mean that we have a decline in unemployment. We're likely to have an increase in unemployment because we're told that we were in a recession. Decline in the terms of trade. No. So remember, the terms of trade is the index of export prices divided by the index of import prices, right? It has nothing to do with the value or the amount that we're importing or exporting. It's to do with their prices, and we've got no information on that. A decline in the level of savings. The economy's in a recession, expenditure is dropping. It doesn't necessarily mean that the level of savings is dropping too. It could be, for example, consumer expectations or speculation, or optimism or pessimism is something that can strongly affect an economy. People may actually increase their level of savings and decrease their level of expenditure if they're expecting that the economy will be going through a continual recession like this for a long period of time. So they may actually save to safeguard against that. But what is likely is to have a decline in the deficit of the trade account, and that is because imports go down. So if exports stayed the same, then we would expect that the deficit in the trade account on the current account of the balance of payments would decline. Remember, deficit is imports down and exports up, or imports down and exports stay the same. So in this case, a decline in the deficit will mean exactly that. It will mean that our imports are going down and our exports are either staying the same or our exports are increasing. Question 25. Diagram shows the effect of an introduction of a tariff on good X by country Y. What is the revenue in US dollars millions received by producers of good X in country Y after the tariff is introduced? Okay, very simple. So we go SX world was what would have been done previously. Then we go to SX world plus tariff. Remember, their revenue will be, they can only make revenue on what they sell, right? So that will be their supply level. Demand level isn't relevant because you might have more demand than products that can actually be sold. You can only make revenue on those that are sold. So very simply, the revenue would be the price multiplied by the quantity, and that would give you 2,000. Two statements. Country can produce a good, lower opportunity cost. That is comparative advantage. Just simple definition. Remember, comparative advantage, lower opportunity cost. Country can produce a greater quantity of a good. That is absolute advantage. Again, just no other explanation necessary except that it's just a definition you have to learn. So that would give us C as the correct answer there. Okay, again, this is not really relevant to the new syllabus for anybody sitting in 2025 or 2026. However, we may as well go through it anyway because it is important to know. So a balancing item is essentially the current account, or the total balance of payments will have to balance, hence why we call it a balance of payments. We could have a deficit or a surplus on our current account, but it will need to be counteracted by the capital account and financial account. So if they don't match up perfectly, what we'll do is we'll input a balancing item to make it essentially go to zero. It's like a double entry accounting system. So good services or good balance and services balances we don't need to take account because we've actually got the current account balance here. And we know that the balance of payments is made up of the current account, the capital account and the financial account. So the capital account and financial account together would be 8,900. Our current account is 7,000 minus 7,000. So in order to get that into zero, we would need to have 1,900 negative, and then that would allow the accounts to balance. So the balancing item would have to be the difference between the current account and the capital and financial account added together to bring us into zero. Okay, what is correct about the causes of inflation? Cost push inflation can be caused by a rising exchange rate. No, it can be caused through depreciation. It's not caused by an appreciation. We just explained how a depreciation can cause it in a previous question in this paper. It can be caused by lowering indirect taxes. No, because that lowers the cost of production. Remember, cost push is relating to the cost of production. Demand pull can be caused by rising exchange rate. No, rising exchange rate will reduce demand pull inflation because it will move aggregate demand to the left. Can be caused by lower direct taxes. Yes, it can, because that is an expansionary fiscal policy designed to move aggregate demand to the right, and therefore it could cause demand pull inflation. Question 21. As part of its trade policy, a government subsidises the cost of machinery used to manufacture goods for export. How will this affect the balance of payments? Okay, so the first thing is it's not going to affect the capital account because the goods are being used for export, so it will be part of the balance of trade in goods. And the balance of trade in goods is part of the current account on the balance of payments. Okay, so then very simply, increase or decrease the deficit is what we need to answer. If we are increasing the deficit, imports will go up, exports will go down. If we're decreasing the deficit, then imports will go down and exports will go up. And if we're subsidizing machinery to manufacture the goods for export, then we're definitely going to increase our exports, which would tell us that we're going to decrease the deficit on the current account. Okay, question 20. A government devalues its fixed exchange rate, so it essentially depreciates it. What does that do? Price of exports down, total exports up, price of imports up, total imports down. What can it do? It can move aggregate demand to the right because X minus M, which is our component, is exports and imports, can go up. So, therefore, if aggregate demand is moving to the right, most likely to be its aim is definitely not to reduce demand pull inflation, because aggregate demand would have to go to the left to reduce demand pull inflation. To reduce a current account surplus, so again, reducing a surplus would mean that imports would have to go up and exports would have to go down because we're reducing the surplus, and that's the opposite of what's happening. Increase the level of aggregate demand, definitely, because we've just explained that in our little synopsis over here. And improve terms of trade, it will not. It will deteriorate or fall the terms of trade because remember it's relating to prices. Imports go up, exports go down. That will cause a deterioration in terms of trade. Okay, what will cause a movement along an aggregate aggregate supply curve. So very simple. A movement along an aggregate supply curve is going to be a change in AD, right? So therefore we're looking for something that's going to change aggregate demand. Rise in the price of raw materials will not cause a movement along that curve. It will cause aggregate supply to go to the left and cause cost push inflation. Rise in the productivity of labour will cause aggregate supply to shift to the right. A rise in the rate of sales tax also will not affect a movement along the aggregate supply curve. If we have a rise in demand for exports, however, X minus M will increase, and we will have a shift to the right in aggregate demand, which we can see will cause the movement along the aggregate supply curve here. Okay. Education from 4 years old to 16 years old in most developed countries is provided at zero price, financed from taxation. Why should the government do this? So, remember that education is a merit good. Education and healthcare are two private goods that are merit goods, and they generate external benefits. So, free market consumers will be unwilling to pay. That is just plain false. Free market education is not considered a private good. We just explained it is a private good. Education is non-rival, non-excludable, so consumption is zero. Now that would be true if it was a public good, but we've just explained that it's a merit good, and therefore it's a private good. Okay, so that does not explain why. What does explain why is that it's a merit good, so consumers have imperfect information. They're not aware of these external benefits that it will generate, and therefore they don't realize the socially optimum level, which means that the governments have to try and provide it to get them to experience these external benefits that it generates. Okay, table shows sources of government revenue in a fiscal year. We're asked, what is the total amount in billions of tax revenue raised by indirect taxes? Okay, students will often get this question wrong because there's some taxes in here you may not have seen before. So first of all, the sale of government assets, it is a source of revenue, but it's not a tax, right? So it's not an indirect or a direct tax. Tax on self-employed, that is a direct tax. Okay, it's like their form of income tax. Carbon tax on goods produced would be an indirect tax, which, remember, an indirect tax is a tax on goods and services. So that's what we're looking for. Corporate taxes or corporation tax is a direct tax. Capital gains tax is also a direct tax, right? It's a tax on the sale of assets. For example, you might have to pay capital gains tax if you sell shares and you make a profit on those shares. Goods and services tax is an indirect tax, and so is air passenger tax. They're both taxes on goods or services provided. So if we add those up, we've got 100, 1,000 and 100, which gives us 1,200 as our tax revenue raised by indirect taxes. Okay, in the diagram, S1 and D1 are the initial supply and demand curves. What would be the new supply curve following the removal of an ad valorem tax? Okay, so remember that an ad valorem tax is a tax that is a percentage of the product, right? So basically what happens with an ad valorem tax is the higher the price that you pay for the product, the greater the value of tax you will pay, because it's taxed as a percentage of the product. So what's important is recognizing here which graphs or which out of A, B, C and D are actually ad valorem taxes, and that would be D and it would be A, because what you can see is that the tax is not straight. So B and C here B and C would be examples of specific taxes, right? Which is where the value of the tax that you're paying, even as the price of it rises, does not increase. And that is because it is taxed as, or it is taxed on a unit of the good. Okay, so therefore, when we remove a tax, we know that the supply curve has to shift to the right. And if we're shifting to the right, all we have to do is identify which one would be the ad valorem tax, and that would be D, so that would be our only logical answer there. Okay, just remember ad valorem taxes will look like that, or they may look something like this. Specific taxes will be straight line taxes, okay, because there's a clear amount of the tax that you pay no matter what the price. Ad valorem will be more curved upwards or outwards, and that's because in here the gap gets bigger. As you pay a higher price, you start to pay more tax on the product. Question 15. Diagram shows the effect of a government introducing a subsidy. What are the effects of the subsidy on government spending and consumer spending? Okay, so first of all, the government spending is the amount of the subsidy that is generated. The amount of the subsidy that is generated is calculated by taking the new supply up, okay, and then we just take it across. So it includes the value of the subsidy that the producer is receiving and the value of the subsidy that the consumer is receiving. Here is the consumer benefit from the subsidy, and in here is the producer benefit from the subsidy. The producer benefit is what they get to hold from the value of the subsidy, essentially like free profit. Consumer benefit is the difference or the lower price that they're paying, which we can see is the difference from what they were previously paying at $10 to what they're now paying at $8. So therefore, the total value of the subsidy would be that area, which is 12 minus 8 gives us 4, multiplied by, because subsidies are given per unit, remember, so it's multiplied by the new quantity, which is 120, and that would give us $480 million, which is the total government spending. The consumer spending is very simply price multiplied by quantity. So the consumer spending at the new level is 8 multiplied by 120, which gives us 960. And the previous spending was 10 multiplied by 100, which gives us 1,000. Okay, 1,000 is old, 960 is new, therefore we can see that their spending has decreased by 40 million. Okay, question 14. What will definitely stop following the nationalisation of an industry? Closure of unprofitable factories will not definitely stop. Remember, nationalisation is where the government are now controlling it. They may keep unprofitable factories going because they want to keep employment levels. Price increases for the industry's product doesn't have to stop if we have nationalisation. Prices may be lower when they were than when they were controlled by the private sector, but it's not necessarily true that the price increases will happen for the industry's products will stop completely when we have a nationalised industry. They may be highly inefficient and they may have to charge a slightly higher price. Job losses will also not completely stop. Not definitely. They may stop, but definitely they won't. Dividend payments, however, will definitely stop because there is no industry shareholders now. They're controlled by the government, and the government is not going to pay dividends to themselves from an industry that they own. It only happens in private sector. Knowing of which combination of demand elasticities would be relevant to a firm trying to increase its revenue. Okay, very simple. Everyone is relevant. PED is relevant. XED is relevant and YED is relevant. YED is relevant in determining, for example, what they should make during a period like a recession. XED is relevant in terms of their sensitivity to substitutes and complements and how they can implement pricing structures based on that. And PED is relevant, or possibly even the most relevant, because it will tell us how the demand will respond to a change in price, whether we are elastic or inelastic, and therefore how we can possibly increase our revenue by either changing our PED or by changing the price of our product. Okay, how can an economist establish the market demand curve for a private good? Okay, remember, market demand is the total sum of the individual demand curves. So consumer surplus and total expenditure has nothing to do with it. PED has nothing to do with it, of individual demands. That is to do with the individual consumer, not the actual demand. And price multiplied by quantity is just a method of calculating revenue. It has nothing to do with calculating market demand. So all we're left with is combining or summing, which is what we said the market demand curve is, the individual demand curves horizontally, and then the total sum of them are going to give us the shape of the market demand curve. Okay, a private company achieves a producer surplus at the equilibrium market price. So what does that mean? That means that essentially they're going to look something like this, right? Producer surplus, remember, is where the let me just get it here, is below the price to the bottom of the supply curve. It's essentially the benefit the producer receives for being able to charge the equilibrium price when actually they would be willing to charge much lower price down here to supply the good. So if private companies choose to prioritize profits over consumer needs, that will not reduce the size of the surplus. If they start to pay dividends out of profits, that does not affect the size of the surplus either. Remember, the surplus is just affected by the selling price of the product and what they're willing to actually supply it for. Private company supply curve becomes more elastic. That would reduce the size of the surplus, because if we just draw a very simple diagram here again. So in the first one we've got, let's say, unitary supply. Here, for example, we can see that when the supply curve becomes more elastic, what happens is that it has to start from a point which is higher up the vertical axis. And therefore, if it starts from a point that is higher up the vertical axis, the total area of the producer surplus would be much smaller, because as it becomes more elastic, they're more willing to charge a starting higher price than they would be previously, which reduces the total area. So we can see here, when it's unitary, for example, the area is much larger. When it's inelastic, it would be even larger than that. And then when it's elastic, the producer surplus area is smaller. Government fixes the price of electricity below the market price. Again, that wouldn't affect the producer surplus. We don't know what this private company is making, right? So if government fixes the price of electricity below the market price, what is that going to do? That's going to restrict, it's going to restrict the availability of electricity, right? Because it's going to reduce the supply and it's going to increase the demand. That might actually cause the supply curve for this private company to shift to the left. And if you shift this to the left over here, you can see that that will actually reduce the size of the producer surplus. So it is a possibility, right? However, the one that is definitely going to do it is D, right? For C, they may not be affected by the price of electricity, for example, or they may still be able to get access to the price of electricity, so we can't say definitively that it will definitely reduce their size of the surplus. We have to take the option which is the most logical and will definitely do it, and that is the elasticity of the supply curve. Okay, good X and good Y are complements. What would be the effect on the equilibrium price and quantity of good X of an increase in the supply of good Y? Okay, so let's do good Y first. Good Y here is going to have an increase in their supply. So good Y is going to look something like this. Okay, now what would be the effect on X? So if they're complements, the increase in the supply here would extend the demand, right? Now if they're complements, they're consumed together. So that means for good X, what we would expect to see is we would expect to see good X having an increase in demand because of the extension in demand that has happened in good Y. And therefore what we would expect to happen, or we can see in the diagram if we can recognize what would happen, is that we'd expect to see, because of the increase in demand, the price of good X to rise and the quantity traded of good X also to rise, moving to the right here. Okay, the supply and demand shift question. Cost of producing meat rises, that would shift the supply curve to the left. Cost of production increase, so we'd move from X into here. Trend for consumers to change from meat to a vegan non-animal diet, and we are looking at the market for meat. That would be a change in consumer tastes or preferences or attitudes, which would shift the demand curve to the left and would result in us ending at A. Question 8. A market is in equilibrium with 100 units of the product sold at $10. PES is 0.20, PED is minus 1.0. What will be the state of the market if a minimum price of $11 is imposed? Okay, so very simply, the price of the product is changing by 10%, right? So price is changing by 10%. If we know our formula for PED and our formula for PES, we should be able to calculate this very easy. Price changes by 10% and it goes up. Because PED is a negative figure here, minus 1.0, that tells us that the demand has to reduce by 10%, right? So the demand reduces by 10% from 100 would leave us with a demand level of 90, right? Now for PES, it's a plus figure, which tells us it has a positive relationship with price. So if price goes up, the quantity supplied will also have to rise. It will rise by 20% because it's plus 0.20 or 2.0. So quantity supplied will go on top of the formula, and therefore it'll have to increase by double what price does. Therefore the new level of supply, which will move in the opposite direction, will be 120. And the state of the market, as we can see here, is supply is 30 more than demand. So we will have excess supply of 30 units. Okay, question 7. What will lead to a downward shift in the normal supply curve? A downward shift is a shift to the right, remember? So we'll be looking for example, a decrease in cost of production. A rise in the cost of transporting goods is a rise in the cost of production. Supply would shift left. We would call that an upward shift. Rise in productivity of labour force, that would be correct. That would allow us to make more. Supply would shift right. Rise in sales tax, supply would shift left. Increase in cost of production. Rise in wage rate, supply would shift left. Also an increase in cost of production. So we'd be left with B as the correct answer there. Okay, PED is equal to 1. That makes it unitary. Now remember, if it's unitary, that means that its revenue cannot change, irregardless of the price, because every time price changes by 10%, demand would also change by 10%. So what will be the result of it? Percentage change in price will cause demand to fall by a larger percentage. Not true. Demand will fall by the exact same percentage. Demand to increase by the same percentage. Not true. Increase in price will cause demand to fall by the same percentage, not to increase. Quantity demanded will always be the same whatever the price. Not true. Quantity demanded will change at the same proportion as the price, but it will not stay the same if price changes. And firms' revenue will always be the same. That is true. With unitary PED, revenue will never change, irregardless of the percentage change in price. Okay, question 5. What statement about PES is correct? It cannot change in the short run. That is wrong. It can change depending on the determinants of PES, their ability to store, whether it is perishable or non-perishable, the level of spare capacity that they have, for example. It increases as the time period lengthens. That is true. As the time period goes on, the availability of obtaining capital equipment, for example, will become easier over a long time period, which will make their ability to be able to supply their product to the market easier, and therefore it will make their PES value more elastic. Infinite in the momentary time period, no, blatantly false. And it is 0 in the long run, also blatantly false. We just said it becomes more elastic in the long run. Okay, which statement would be classified as positive? Remember, factual statement that can be tested. Balancing the budget cannot be more important than reducing inflation. That would be a normative statement. It's an opinion or a subjective statement. Maintaining the real income of pensioners needs to be a priority. Again, that's an opinion, so it makes it normative. Government should increase indirect taxation. Also normative, opinion. Government will not increase direct taxation. That's a positive statement, one that can be tested. Question 3, please ignore, no longer on the syllabus. So question 2, which aspect of a planned economy might be viewed unfavourably by a consumer but favourably by a producer? Okay, so what aspect of a planned economy controlled by the government will a consumer not like, but a producer will like? Okay. Bureaucratic system of decision making, no, they will both view that unfavourably. Long response to time to changing economic events, again, they will both view that unfavourably. An absence of incentives to work and to produce, that would definitely not be viewed favourably by a producer. They would want incentives to work and to produce. Emphasis on the production of capital goods, that would be the correct answer. The consumer would view that unfavourably because the consumer wants consumer goods, which are directly correlated to their living standards. The producer, however, wants to produce capital goods as it will allow them to increase their productive capabilities in the future. And finally, question 1. A tourist visits the coast for a holiday. First day she visits a local tourist office for information, goes for a swim in the sea, spends the evening enjoying the view of the coastline, and rents a campsite for an overnight stay, okay? Remember, economic goods involve factors of production and free goods don't. They're not scarce and they have no opportunity cost. So if we go through these here, swimming and sightseeing, they're definitely not economic goods, right? Because there's no factors of production involved in them. Sightseeing and camping, so camping would be an economic good because you need a tent, right? And you do need factors of production involved in order to go camping. You don't for sightseeing, however. Swimming is not an economic good, as we just explained, so that only leaves us with A. Camping would be an economic good. We do need factors of production. Now, you might think that information is a free good, but we're told that she visits the local tourist office for information. That means that labour must be employed in that local tourist office in order to get the information. So technically that means that there is the deployment of factors of production for that particular information. Swimming and sightseeing, however, are free goods. There's no opportunity cost. They're not scarce. And therefore there's no factors of production that need to be deployed to enjoy them. Okay, and that's the end of this paper.